According to a 2024 MassMutual study, the average American views 63 as the ideal retirement age. However, thanks to strong portfolio returns over the last few decades, some investors now find themselves financially ready to retire well before that average. Retiring earlier, say in your mid-50s, means finding a way to bridge the income gap to age 59 and a half without letting the IRS 10% early withdrawal penalty eat into your savings. The good news is that there are specific IRS-sanctioned strategies designed to let you access your funds and avoid paying penalty altogether. The two primary tools for this are the Rule of 55 and the Internal Revenue Code Section 72T, which is also known as the Substantially Equal Periodic Payment Strategy. Hi, I'm Justin Kuntz, Managing Director of Pacific Wealth Management, helping you make good financial decisions through sound management for a secure future. If we look at the data from the MassMutual study, we see a fascinating gap between the expectation and reality. While 63 is the age people aim for, the average actual retirement age in the US is actually closer to 62. Even more telling is that nearly half of all retirees reported leaving the workforce earlier than they had originally planned. Often, this isn't necessarily by choice. It can be due to a health change or shifts at work. And that means that having a strategy to bridge the gap to 59 and a half isn't just for those planning for the early exit. It could be for you too, where it comes unexpectedly. It's a vital contingency plan for anyone who might find themselves retiring sooner than they originally expected. However, it is important to keep the big picture in mind. Interestingly, psychologists have found that there is actually a very weak correlation between a retiree's financial circumstances and their overall life satisfaction. The data suggests that objective physical health is actually a much better predictor of happiness than your account balance. So, as we discuss these withdrawal strategies, remember that the goal is to provide freedom and security, but the real wealth in retirement often comes from your health and your time. Let's start with the Rule of 55. This is a lesser-known provision in the tax code that allows you to take penalty-free distributions from your current employer's 401k if you separate from service in or after the year you turn 55. Timing is obviously the most critical component here. You must separate from service during or after the calendar year in which you turn 55 years old. It's also important to remember that this rule applies only to the 401k of the employer you just left. You can't use the Rule 55 to access funds from a previous employer's 401k plan or an IRA. Finally, your plan must specifically allow for these types of distributions. While the Rule of 55 is a federal provision, employers are not strictly obligated to actually offer it for your plan. Some plans may even limit the number of distributions you can take per year, which is why reviewing your summary plan description is a critical first step in this whole thing. If you retire before 55 or need to access the funds specifically in an IRA, the Rule of 55 isn't an option. In this case, you may be able to use substantially equal periodic payments under the Section 72T rule. This strategy allows you to take a series of specific predetermined distributions from your IRA or 401k penalty-free, regardless of your age, provided you follow a very strict schedule. This requires a significant commitment. You must continue these payments for at least 5 years or until you reach age 59 and a half, whichever period is longer. Once you start, you generally cannot stop or change the payment amount without triggering the IRS to retroactively apply the 10% penalty plus interest to all previous distributions. It's effectively a one-way street until you reach that 59 and a half milestone. While 72T and the Rule 55 waive the 10% early withdrawal penalty, they don't give you a free pass on regular taxes. Every dollar that you withdraw is actually treated as ordinary income and is subject to both state and federal income tax. Additionally, when you take a withdrawal under the Rule of 55, the IRS requires your plan administrator to withhold 20% of the distribution for federal taxes automatically. You must account for this when you're calculating your net cash flow needs. If you need $50,000 to cover your expenses, you actually have to withdraw more from that account to account for the 20% slice that's going straight to the IRS. Beyond the rules themselves, we have to consider the long-term impact to your portfolio. Taking money out in your 50s means that capital is no longer compounding within that account. This increases longevity risk, the danger of outliving your money. This is why we often look at these strategies in conjunction with other assets that you might have, like taxable brokerage accounts or health savings accounts, to create a tax-efficient waterfall of income. Ultimately, optimizing early retirement isn't just about avoiding penalties. It's about aligning your decisions with your long-term financial goals and your current cash flow needs. At Pacific Wealth Management, we believe these strategies should be viewed as part of your broader financial plan rather than simple stopgaps for cash flow. With thoughtful planning, these rules can be powerful tools to help you bridge the gap to secure retirement. I'm Justin Kuntz, Managing Director at Pacific Wealth Management, and if you're interested in learning how you can do more to make your retirement as easy as possible, visit us at www.pacwealth.com. Thanks.